Awesome. Thanks so much for this adequately impressive tour de force. Allow me to start the discussion between the members of the panel after we open to you all. I would like to start exactly by where you ended, which is the question of the intra-euro area imbalances. You make this absolutely correct point that in the end of the day we are all small open economies within the euro area. Now, if we do take that those imbalances do exist, if they are relevant, what are the policy implications that we have for the euro area?
Euro area, of course, there are policy implications, but there are also. I'll just shout, please. There are things you do with monetary policy, and there are things you do with other policies, which is, I think, a very relevant point to make about the currency area, where you have imbalances, regional imbalances, and different sovereign fiscal. So,
Unfortunately, we do need to have you on the mic because we are recording.
So,
given that this thing is not cooperating,
will this work? If I
Is this
yeah.
picking up? Okay. All right.
So, sorry, I'm getting distracted. Microphones. Fiscal policy, monetary policy. I think this is what I'm addressing here. The tools that are available for monetary policy, they're not non-existent, but there are fiscal policy tools which are much more directly focused on demand imbalance. Why are the monetary policy tools non-existent? Well, part of the problem that we have in the euro area and have had for quite a few years now is the imperfection of the monetary transmission mechanism. You can measure this in different ways. But one way of measuring it is to look at the spreads on say, corporate lending to the corporate sector from the banking system in different parts of the euro area. Banks in the euro area can all borrow at the same rate, but at the end of the day, the borrowing rates for corporations in different parts of the euro area are quite far apart, widened out during the crisis, and have come in a bit, but haven't come in fully. And that is a transmission mechanism problem, which is embedded in the way the banking system works, in confidence in the banking system, and so forth, which are all areas for monetary policy tools. Some of them, though I absolutely agree with what Adam says, there's a heavy inverted commas around non-standard measures. I'm thinking, really traditional, old-fashioned monetarists like Brunner and Meltzer. What were they doing on interest rates? No, they were saying interest rates wrong. Don't look at interest rates. Buy assets, sell assets. But anyway, that's but there are one has to think of nuts and bolts and plumbing to improve the transmission mechanism of monetary policy into the areas which are demand efficient and have a weak transmission of monetary policy into them. So there are tools of monetary policy that are present.
I will need to continue with this point and make the obvious remark that imbalances imply adjustment in different parts of the monetary union. Right? What you essentially refer to are adjustments in what we might call the periphery of the euro area. Now, the counterpart adjustment of it in terms of the core of the euro area, if you will, would be export demand shock in one way or the other to the other members of the euro area. From this point of view, what the adjustment then should be in this part of the core?
I have the privilege of being a central banker, and that's why I like to talk about tools of central banking, and not to spill over into tools that are available to other parts. I don't think we want to impair the transmission mechanism of low interest rates into the more or less to Germany, to the Netherlands, into countries where there isn't a problem, in order to level the playing field in a bad way. So I'm not sure that there are easy tools of monetary policy to achieve what you're talking about, which is some kind of shift in demand behavior, tilted demand behavior against those countries that are maybe close to full employment.
I would like to open to the audience now, making the precision that we are recording this. So please raise your hand, wait until we deliver a microphone to you, and only then start your question. So with these hopefully clear Germanic instructions, I open the floor to questions. Please. We have a gentleman here.
Well, thank you very much. I would like to take up the point of...
I should also have indicated that you should please state your name in the
Yeah, Francesco Badia. So I would like to take up the point of Adam about, which is not only semantics, about unconventional, non-standard, exceptional, to say that there is definitely one sense in which QE is exceptional. And this is empirical. Professor Ferguson has provided a very interesting chart where he looked at the balance sheet of central banks since the beginning of last century. And there are only 2 episodes in which there was such a huge increase of balance sheet as we have had since 2008. And this is World War I and World War II. So you cannot say that this is not exceptional, at least in empirical terms. So my sense is that doing QE was right, but it would be wrong to say that this is just normal kind of policy action. It is not, at least in empirical terms. And it due to extreme circumstances that you have to take extreme measures, but you must be aware that you are taking extreme measures that carry some risks.
You're referring to the stuff that Neil Ferguson trotted out at Central last year. I'd suggest for everyone another very good recorded conference was the ECB's first annual monetary conference at Central last June, I guess, May or June. And at that, Professor Neil Ferguson of Harvard did trot out the chart that Francesco was referring to. And Charles Goodhart and others stood up from the audience and explained why it was completely misleading. And the Central volume was held and published by the ECB, and I'd suggest everyone go read it. But leaving that aside, there's a difference between empirically observable and significant, as Francesco knows well. I am not sure that the benchmark of what constitutes central bank size as a percentage of GDP is a meaningful benchmark. If we live in a world of far higher leverage ratios and financial multipliers and financial complexity, as well as in a world of much higher cross-border capital flows in gross terms than we did either during the 40s or the 1910s, the meaning of comparing those episodes to this episode is completely unclear.
The gentleman here, please, can be
Matthias Stratton. I think Adam Posen made a very valid point that international imbalances do not matter so much if you make the assumption, of course, that you have flexible exchange rates. But what we've learned during the last crisis is that internal imbalances matter hugely, both within the euro area but also within the United States. And so is it not a valid point for people to ask whether central banks do take those imbalances into account and what quantitative easing, for instance, has an impact on internal imbalances within economies? We've seen since the financial crisis that initially debt levels were reduced a little bit, but since then this deleveraging process has basically come to a halt, and if anything, we're seeing rising debt levels again. So internal imbalances are rising again, and within economies you don't have an adjustment tool similar to exchange rates. So do we need to take these things into account, these internal imbalances and what QE does to them? And then as a second question, specifically to Adam Posen, do you think that the imbalances within the euro area, and you mentioned the role of Germany, can be resolved without a breakup of the euro area. And then related to that, if breakup is the only solution, which some people may think, then does QE actually make the whole thing much more expensive than it would be otherwise? And maybe detrimental from that perspective.
Adam will give a very brief reply to those two short and simple questions.
I was brief on the last one.
Patrick, do you want to say anything? I'd just like to comment on the first aspect of it, the others being not so relevant. I think it was a big mistake for the first 8-9 years of the euro not to focus on internal imbalance in the euro area, national balance of payments. There was an attempt to, let's understand euro area as a whole, as a single economy, let's not talk about national economy. It's one area, let's examine that, and let's do all our calculations on the basis of that. This was a mistake. It allowed imbalances to emerge and not be really observed. Now, that has been corrected to some extent, but in a very strange structure, that's sort of troika structure. If you got into a bad negative imbalance, then you had a troika structure, and then you've got to get sorted out. But it still isn't part of the analysis as much as it could be and should be. It's not easy, of course, because I'm sure the Federal Reserve, they don't really do in-depth analysis of Arkansas. It's complicated. There are 19 members, but I think it's still an issue that requires fuller, more articulated.
And I don't know, give an even shorter reply.
I think there's multiple dimensions of what you're calling internal imbalances. One is this geographic aspect that you and Patrick rightly raised, and it's quite right that central banks don't get into that. We do have regional reserve banks in the U.S. and we do things, but just as at the ECB, nobody's supposed to be voting their district when they're making decisions because it's just politically untenable. The more, to me, the interesting question is what you raised about internal imbalances in the sense of indebtedness and leveraging. Just quick plug, we're doing an event in Washington on reassessing debt and deleveraging around the world on February 18th. It'll also be online if people want to watch. My take is not quite as gloomy as yours, but whether it is or is not, the bottom line is, this goes back to Patrick's point about tools and his hammer. Sometimes you can use one end of the hammer, sometimes you can use the other end of the hammer, sometimes you need a wrench. If I'm worried about bad lending and indebtedness, that's what I have supervision for. That's what I have financial regulation for. And I would rather develop that tool. So finally, in terms of resolving internal imbalances, yes, absolutely. The Eurozone can survive these internal imbalances, partly because the appetite for adjustment in Spain and Portugal and Ireland to remain in the euro area is so enormous. And partly because someday, God willing, there will be fiscal transfers in the euro area in a meaningful way, the same way we deal with it in the U.S.
Before we go to the final question, I really feel very tempted to ask Steve about internal imbalances within the United States. Again, as an European with European sensitivities that live in the country, can tell you it's a far less integrated place than what we actually do. But anyway.
Well, my first response to the gentleman's question was, well, the key in internal imbalance that we're focusing on at the Federal Reserve is between supply and demand. And in an environment where our recovery for years had been flagging and it looked like there was insufficient aggregate demand to push the economy along and push jobs up. That was the key issue that we were focusing on, was resolving that imbalance. Now, we were very aware that there are financial imbalance implications of monetary policy. And so we were always very cognizant and explicit about evaluating the costs as well as benefits to our asset purchases. And we regularly review that. So far, we have not identified systemic large imbalances and financial vulnerabilities that would have us stay our hand monetarily. And as Adam pointed out, our policymakers have been fairly explicit that there are other tools besides monetary policy to address financial imbalances like macroprudential, so that monetary policy can focus on its objectives.
Thanks for that, Steve. The lady here will be the final question, unfortunately. Please identify yourself and your organization.
Hi, my name is Naomi Chapman. I'm from the Asian Development Bank, and I'd like to bring Asia into the conversation since we're talking global. First of all, thank you, Adam, so much for saying about the imbalances. In Asia, many economies, following the crisis in the 90s, maintain surpluses purposely. I mean, the issue there is more, what do you do with those savings and how do you use them? That's what we struggle with. But to go back to Stephen's comment, I'm really interested about that because you talked of the spillovers in a very lighthearted way. Well, in Asia, we had some spillovers and inflated asset prices, and we certainly did scream when we felt the impact of the tapering. I'm just curious to hear from this panel what they might anticipate, and I don't know the mechanisms of Europe QE. So will that have an impact on Asia? I mean, what do you think about it? Because the globe is not Europe and the U.S. or Asia, and there are other regions of the world. So appreciate your thoughts on that. Thank you.
I think that perhaps you could, and the other members of the panel
Well, as I mentioned before, in a highly globalized financial system, shocks in one economy are naturally going to reverberate to others. Okay, that's unavoidable. We do the best we can to reduce those reverberations by clear communication of our policies, but we can't always be successful. So all economies need to make sure that they reduce their vulnerability to shocks by strengthening their financial system, by putting in place appropriate policies. Now, on the issue of spillover foreign policies, I will note that even as there were many critics of our QE at the time, when we were doing that. Most policymakers abroad were in agreement that the policies that we implemented in order to keep the U.S. economy growing were actually better for the rest of the world. There are very few people who say they wished we had not pursued QE. They wished we had let our economy kind of like recover without that help. By the same token, when the situation calls for normalization, if we were to delay that because of concerns about its reverberations abroad, the markets would only then anticipate that when we did start to normalize, it would be even steeper, okay, and it would be faster tightening, and that would probably destabilize markets. So there's really not a lot of substitute for doing what you need to do in order to get the economy back to balance.
And, the way I think about this is, when the taper time came, everybody said the interest rate curve is turning. This is the turning point. But already, very quickly after that, the ECB established, no, wait a minute, there's more than one interest rate curve. We decoupled, and the market understood that we were decoupling. And to some extent, you might think of it as, from your external point of view, external to both the euro area and the US, it's the baton has handed from the US to the ECB. The US is begging you to take it. Yeah, essentially, the way in a paper.
Yeah, go on.
And so the baton of action to provide that stimulus that generates the inflation back to there's an inflation depression in lots of parts of the world. So there is a spillover of the European QE into Asia to maintain that upward monetary pressure on inflation that is otherwise being pressed down by other forces. So that's the way I think about it.
Just one line, Emily. As you put it, and I tend to agree with you, that the issue is what are the Asian governments and the Asian people doing with their accumulated savings and reserves. And this is something where the Fed has a role to play, the ECB has a role to play, but ultimately it's got to be Asia itself dealing with it. I think the other point, though, is in the spirit of what Steve and I were both saying earlier about alternative tools, is, and I know the ADB's done a lot of work on this, we've worked with them on this, Asia has been, particularly advanced Asia, has been the real place of experimentation and implementation of macroprudential tools in a way that the US and Europe have not yet been. In some cases, it seems to have worked okay. in some cases less so. But I think I commend the policymakers in a large number of the Asian financial centers for grappling with that and trying in real time to figure out what's the right tools to use when they've got, if you're Hong Kong or Singapore and have a huge real estate boom, irrespective of what the Fed does. How do you cope with that? And I think we're never going to know until they try, and I appreciate the fact that they have the guts, the vision to try.
With this, I would like to invite all of you to follow me in a round of applause throughout.